So we want to think from where we were yet the last time. If I want to clear it and probably proceed to the next topic. So we are on inflation and employment. I think we started with employment. I looked at what it is. So the topic is still where we were. We are on inflation and unemployment. So we had discussed unemployment last time. So today we wish to proceed with inflation. So under inflation, there are things that we need to understand. We shall define what it is, give the meaning to explaining what it is. Then we can look at the types that are there, types of inflation. Then after looking at the types of inflation, we shall discuss the causes of inflation. So besides that, we shall also discuss some other concepts. We shall see that later. So the types of inflation, causes of inflation, and also the effect of inflation. Effect of inflation. And how basically be able to address or how to control of inflation. So because we have started with unemployment, we shall also discuss something what we call target inflation. We can discuss that target inflation, what it means. Then we shall also discuss what we call feeling curve. So that will basically you can write Philip, or at times just written Philip, doesn't matter. Then that will bring us to the end of that. So this is what we need to discuss on that, what is remaining, before we proceed to our next discussion. Now, we want to talk about inflation. It is a persistent increase in general prices of goods and services in an economy. So what are we saying? What are we saying here? We are saying that we have to define it. We are saying it is a persistent. It's persistent increase in general prices of goods and services in an economy. That is what is referred to as inflation. Persistent general increase in prices of goods and services in the economy. Now, we have to understand what this particular inflation is. When we talk about general, it means that the prices of goods, the price of bread, milk, sugar, motor vehicle, anything that you can think of in the economy, the services which are being offered, generally the prices of them are increasing. So that is saying, if only the price of one item is going up, for example, if it's the price of the unga that is going up only, and the price of other goods are constant, that is not inflation. That's not inflation. Together, that is not inflation. So inflation happens when generally, if you consider the prices of goods and services in the economy, they are on the increase trajectory. Together. So if the school fees are increasing, the fuel are increasing, the hospital, if you go to the hospital, the charges are increasing. Anything that's any good that you may think of it are increasing. That's what about inflation. ratio. So you cannot really have, as I've said, you cannot have a scenario whereby it's only the price of milk that are increasing, and then you're saying there's inflation. That's not inflation. Together, and the prices of milk, only the price of milk is increasing in the economy, and then you say there's inflation. That's not inflation. Inflation is persistent. I agree with it is persistent. If probably there's a shortage today and the price goes up, but tomorrow the price goes down, that's not inflation. So there should be persistent increase in general prices of goods and services in the economy. That's why we say there's inflation. Together? Yes.
How to
Yeah.
how to find investment there? Because there's a place I read the persistence follow the value of money.
You know you are very right. You are very right. And what is the value of money? Amount of goods which can be bought together. You say here amount of money. When the prices are going up, it means that the money, the amount of goods which can be bought by that given amount is going down. Down. That's also correct. Right together? Because if you have 1,000 today, and let's say you have 1,000 today together, and what is the bread? What's the price of bread? So that's more is around 60. How much are you talking? Oh, 60. Okay, 60. So let's say now let's say just say this is 600. How many are you able to buy? How many? 10. 10 bread. That is today. See it together. Tomorrow it is 120. The price has gone up. How many are you able to buy with the amount? 5. You can see the amount of goods that you're able to buy is going down. That's the inflation. That's another version of inflation. Because value, when the prices are increasing, the amount of goods you are able to buy with a given amount of money goes down. Yeah. Are you together? So that's also another version. So the amount of goods, the value of money must always be understood as the amount of goods you are able to buy, the given amount of money. Then when the prices are increasing, obviously you are able to buy less. The value is going down. I hope that is clear. Now that has been understood. That is the definition of inflation. Everybody will see the problem? Is there a problem? Are you okay? Okay. Now we go to the next types of what? Types of inflation. Types of inflation. Now, you have to understand this. So you have to understand this. Yes, it is a persistent increase. You can see this thing. Increase in general prices of goods as increase in the economy. Increase. What rate? What rate? What rate? So the rates gives us the types together. The rates of the increase in prices gives us the type of inflation. It must not be confused with the causes of inflation which we are going to look at into. So the type of inflation, we have what we call hyper, or it's also referred to as yellow page, or it's also referred to as runaway inflation. Hyper or runaway inflation. Hyper, galloping, or runaway inflation. Now we say this is where the prices are increasing at an alarming rate. So it is where the prices of goods and services in an economy are increasing at an alarming rate. So here in this case, money the functions of money is low. Together. The function of money is low. You know what money, the function of money? Pressure over, store over. Together, the function of money is low. Now, like what happens in Zimbabwe sometimes back, for a very classic example, you go to a shop, you buy an item for 100 shillings today. Tomorrow you go to the same shop, that item you will put up 100 today, It's now 1,000. More, it's 1,000. The next day you go, that item is now 5,000. The following day, then we talk about Zimbabweans. They are poor millionaires. Poor millionaires, they have millions, but the value of money is galloping, hyperinflation. So we say the money, the functions of money is lost. That's such as the function of money is lost, and that's why even what happens during those times, people lost trust in their own money. They lost their trust. They no longer want to use their own money. The Zimbabweans, they never wanted their own money. They want to use dog. They are no trust in their own money. So you can see it doesn't happen until basically they were only using dollars. So they don't want their own money. Because in this situation, pesa mia moja leo, kesho unaenda kununua the same thing, 1,000. The following day it is 5,000. The following day 10,000. The same thing that you bought the previous day 100.
Increasing in trades.
Yeah.
Those money products.
What am I saying? It is where the price of goods are certain are alarming. So you see alarming. Are you seeing the word alarming there? It's alarming, scary. Not great. Talk about
What about the government? Because in the fee.
Right? You see that's why we are like run away. When there's something run away, it is beyond control now. That's why we talk about run away inflation. It is beyond control. Where it's beyond control. Until the government also requested, they requested people to bring in their money so that if you have, let's say if you have this much, you are give a different money. You are given a different money now that reads this one. So the 3 zeros are knocked out. And still it could not help the situation. It could not help the situation. Just like our money, we were told sometimes back to surrender 1,000. You were told to surrender some money, thousands and so forth, so that you can be given new currency. So they also request their people to bring in money so that they are given a new currency with new denominator. So ukileta hii unalipewa hii, but with the new and another money. So that it would not work still. It fails to work. So we are saying that's called hyper or galloping inflation. Now we also have another one called creeping inflation. So we have said that these types of inflation, they are categorized based on the rates at which the inflation is increasing. So creeping inflation usually happens where the rate of inflation is very low. Usually, where the rate is between 1 to 4%, then we talk about creeping inflation together. So for creeping inflation, it's not harmful to the economy. Of course, at times that we have already talked about target inflation. So at times the government may bring in policy measures to ensure that it is able to achieve a given level of inflation, like 2%, because they consider that such a level may stimulate economic activity together. It's not harmful to the economy. So where the prices are increasing, so where? So this is where, so this is where prices are increasing at around 1% to 4% there. So this is not harmful. It is not harmful. It is not harmful for the economy. So that's not harmful. It's not harmful. It's not harmful. Of course, such stimulates economic activity. So that's that. Now we also have what we call. So at times we also have what we call so-called high inflation. So high. So when we move from creeping to creeping inflation, then you can also have high inflation. You can also talk about high inflation. So high inflation, any increase in prices above 6% is considered to be high. So we talk about high inflation, but not around when it reaches around 50%, 100%, then now we talk about hyperinflation. So high inflation is any increase in prices above 6% is considered to be high. It's considered to be high. It's considered to be high. So some other books also talks about what we call moderate inflation, around 5%. Then we talk about this. We talk about the number one. We talk about number two. talk about number 3. And also we have the fourth one I want to talk about. It's called suppressed inflation. Suppressed inflation. Suppressed. When you suppress something, what do you mean? When something is suppressed, it means what? Yeah, it has been there's some pressure for it not to go up. So suppressed inflation happens where there's inflation, but the prices are not rising because of government policies like price control. Together, the inflation are there. The inflation is there, but the prices are not increasing because of the government policy of price control. But we are able to see the symptoms of inflation, for example, shortage of goods in the economy. We're able to see the shortage of goods in the economy, long queues, for example, in shops and so forth. But the prices are not increasing simply because the government has actually set the price. To call that suppressed inflation. It means that the government control prices, then prices will automatically start to increase together. So this happens. So this is where there is inflation. Inflation in the economy. But the prices are not increasing. Are not increasing due to the government control on prices. The government has set a price, so you cannot proceed. The prices cannot increase because the government has set. We're going to talk about maximum and minimum price controls. However, what happens in this case? But the science of inflation, e.g., shortage of goods, long queues, are evident. So we have those signs, those symptoms of inflation. They are evident that is that economy. But the price cannot increase because of the government, price control by the government. Okay, together. So that's that. So we remember when we talk about types of inflation, you just go back to what we have talked about inflation, and then you can see the types are based on the rates. Together, the rates will give us hyper, the rates will give us creeping, the rates will give us suppressed, the rates will give us what we are referring to as high inflation, which are saying rate about 6%. Causes of inflation. Where are we here? Here. Okay. Causes of inflation. Generally, inflation are caused by two broad factors. So we have causes of inflation. Remember, we talked about types. Now we are causes, so that we don't confuse the two. So the inflation is caused by two broad factors. We have demand pull inflation. Inflation caused by demand. So we have cost push inflation. Demand pull inflation and cost push inflation. You know, in the times when you are told to spend those. you say demand push. The moment I see demand push, X. Right together. Or cost pull, X. So you have to be very careful. And at the end of the day, that confusion, I'll clear it away. So I'll clear it so that you don't, because this has, most of the students, they just, that they know there's demand and there's cost. But what is next, they are confused. So they don't know demand push. They don't know whether it is cost pull, they are confused. So, but the moment if you write demand push, X, hakuna demand push, hakuna cost pull, hakuna. It is demand pull inflation and cost push inflation. I'll tell you how so don't mind about that. Before we at the end of this class, you have known what the two, well, the difference between those two. Now we start with the first one, which is called demand. Demand pull inflation. Now, this is basically cost. It's a result of what? This is as a result of aggregate demands. Demand exceeding supply. So that's aggregate demand, aggregate total. Aggregate means total in the economy exceeding supply. So this as a result of aggregate demand. So first it should be as a result of aggregate demand, for goods and services exceeding supply for the same. That's that. You send for me email on set, run for Saturday. So, demand pull. We have learned from our previous studies that where there is excess demand, you expect the pressure to be there, and so that will exert pressure on prices to go up. So, where there's excess demand, what do you expect? Prices will issue. So one of the causes, those percentages that you saw there, hyper and so forth, they may be caused by what we call demand pull inflation. This is a result of aggregate demand for goods, or where you can say where aggregate demand for goods and services exceeds supply, aggregate supply for the same. Basically, we have demand pull inflation. So for this, we can narrow it down. And you can see the reasons for this. Reasons. So, basically, what these ones. So the first thing, reasons or causes of demand pull. Reasons or causes. Causes of demand pull. Causes or reasons for demand pull. The first one you can talk about. You can talk about increase in government spending. Just expenditure, spending or government expenditure in an economy. When the government spending increases, the expenditure increases, the money comes to the in circulation and it is in the pocket of the people. So the wealth is like pumping money in the economy. So people have income and that increases their purchasing power. So increased government expenditure in an economy, it automatically results into people having income. And so the purchasing power increase, and the demand will actually increase generally. So remember, government expenditure is not going to increase the amount of money in the pocket of one single individual. It is in the economy as a whole. So generally, people will be having income, and therefore the demand will decrease. So we talk about decrease in direct income tax. So when the government reduces the income tax, what do you expect? You will be having more money, what's called disposable income. So where there's a reduction in your income, there will be increase on what we call disposable income. And the increase in disposable income simply means you have more money. So the demand will increase. So the general, not on a person. Remember, like this one, you talk about housing levy and so on, so on. So it is everybody's affected. Everybody's affected. So your purchasing power has been affected to the tune of the housing levy. That money is not available for your spending together. But if it was available, you'd use it elsewhere. You'll increase demand. You increase demand. I hope you have signed up to Saturday. I don't want to bring this on Saturday. Not that I'm going to be away. I just be around. But okay, so we are together. So we have decrease in the direct income taxes. We also basically cause basically what we call demand pull inflation. Also, we talk about increase in population. Now, population. When a child is born, an extra mouth is basically comes into existence. So goods, the demand may increase. The increase in population basically will result into increase in demand. And that basically means that when the increase in demand means that the exert pressure on prices to go up. They talk about reduction in interest rates. You have to see the reasoning behind these things. When the interest rate goes down, it's reduced. What happens? Borrowing becomes cheaper, and when borrowing becomes cheaper, people can borrow so as to consume. So they will be able to increase the demand. So the reduction in interest rates, of course, by banks or lending institutions, interest rate by lending institutions. This will actually result into an increase in demand. Also, we talk about basically at times the central bank may also bring more money in circulation. Of course, more money may be printed to address the problem of what we call deficit budget. And so when that is done, it will actually bring more money in circulation. So that central bank policy of printing more money to address deficit. So budget deficit happens where the expected expenditure is higher than the revenue. So instead of borrowing, there are avenues to develop for the government. They can borrow externally, they can borrow from the people, and so on, so forth. So what they can do in this case, instead of doing that thing, there's an option. They can actually be able to print more money to address the problem of budget deficit. So if that happens, all this will cause demand pull inflation together. So causes of demand pull inflation, whatever these attached to either that. And so we are talking about, okay, we shall discuss the differences first, what's in pull and push later. Now we have that, then we go to cost push inflation. We go to cost push inflation. Cost push inflation. Cost push inflation. Cost inflation. This is caused by the increase in cost. So the prices are caused by increase because of product. Now, what happens is this. When the cost of production increases, look at this so that you know what we are talking about here. When the cost of production increases, the increase in cost is simply pushed by the farms to the consumer in form of increase in price, pushing. You are pushing it back to the what the consumer. So that increase in cost will not push, you push it away. And even without that, you know, people, no one wants to assist with the cost. You know, cost you push away, then the entire cost. Then the entire cost. We usually push cost away. So cost push, power, cost what? Push. But demand, when you're demanding something, you pull it. Demand, pull, 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 pull. See, you are pulling it towards you. Demand, pull, inflate. So demand, pull, cost, pull. When you don't want to associate with inflate, we will go. So cost you push away. The same way, if the cost of production goes up, the suppliers, the sellers, the producers will pay the cost, but they will push it to the consumer. How? Prices are going to increase. So they are pushing to the consumer. So the prices, remember the inflation said increase the price. So the prices has increased as a result of the cost of product have been pushed by shifted by the producer, the farm to the consumers. Cost push. Okay? How clear there? Okay, now understanding. Now, if I give if you get an exam, don't say demand pull. Now you can see now at this point at the time if you say demand push, now it's awkward. Now because you know. So if you say demand push, that's now awkward. If you say cost pull, it's now awkward. So because you have understood why you're saying this. Cost, you are pushing it to the consumer. So prices you are increasing the price for that cost. So unalipa, but the cost, the person who is going to bear the burden is going to carry the burden is the consumer, and in terms of increasing prices. So we say that is what? That is cost of inflation. It's where the increase in prices of general goods and services in the economy is brought about the increase in cost of production. So what are the causes of this thing? What are the causes? What are the causes of this causes or resource? So we have increase in raw materials, increase in cost of raw, increase in cost of raw materials. So the cost of raw materials increases will manufacture, but the cost are pushed to the consumer in some form of increase in prices. Increase in cost of labor. Increase in cost of transport. Sometimes back when the fuel was high, see everything was high. When the fuel was high, that's the real cost was high, everything went high. So cost of transportation, increase in indirect taxes. Indirect taxes are like VAT. VAT ikiongezeka, they will pay. But the burden is on you, 16%. But if it was zero, the price itakuwa chini. But because it is 16%, you have to pay 16%. Kwa supermarket uangalie hizo unaona sisi kuna pesa umelipa kwa extra. So the prices has been increased by the much of the indirect tax. So the increase in indirect taxes, they also bring about this cost basically to go up. They also bring about that cost to go up. So we have demand pull, we have cost pull. So demand pull, cost pull, cost center of inflation. Okay, now you may think now with demand, then you talk about. I talk about what when you talk about individual demand there. We talk about factors affecting demand. Talk about the income of consumer. So talk about that. Here it's not about an individual consumer. It's not about an individual consumer. Your income may increase, but that does not mean that mine has increased. Does not mean that. So it is you as a person whose demand is going to be affected, not me. But here you talk about whole macro, macroeconomics, everybody. So that's why we are talking about here saying reduction. We talk about decrease in direct income tax. So here when you are wote wamekuwa employed, tax yao ilikuwa reduced. So at least how demand yao itaenda juu. Lakini kama individual mmoja pekee ndio income yake inaenda juu, it's not going to affect anything. It's not going to affect anything. That's why you also don't talk about the taste of a consumer, because the taste of a consumer will not affect the demand of all goods in the car. Will it affect? Your taste has changed, so everything is going up. It's not possible. It's not possible. So that's why we are narrowing down to the reasons that generally can actually cause the demand, this increase in aggregate. That's what we say the result of aggregate demand of goods and services exceeding supply for the same. So those are the results. Those are the results. Are you communicating? Yeah. So now we go to the effects. We go to the effect.
How the examine that test the questions.
Go to the past papers. Look at how you have been interacting with the past papers and you're able to see what is being out things have been tested here. Have you been interacting with the past papers? Interact with them. And then you'll be able to see how it is. Yes, question?
Just concern the central bank policies, these policies. What are the policies that before the central bank brings the money to the market? So
We have control of inflation which shall come there. That's why the control of inflation which shall come. It shall come there. But remember, we have said it's an option, but it's not really very nice, because if it does that, of course, it's causing inflation there. And that's that's really what fueled even more inflation in Zimbabwe. You are printing. So God was saying there's no need to go borrowing. Why should we borrow? We can be able to print our own money. That's what they did, and you can see what they what happened. Run away in inflation. So
How is the economy there since the
what?
economy providing for right?
I think last time I checked, the Chinese, even they want the regular system.
The things are not stabilized there.
Yeah.
Things are not stabilized.
The Chinese on the most of their government.
The things have not changed for any better. The things are not okay. Things are not really okay. So we should not go there. So really, it's not a direct thing. Of course, they were misadvised. Of course, when the former president took over, those and they were the one who were holding the economy. So they were the farmers, commercial farmers. Then unafukuzwa, unapewa shamba wewe na hakuna kitu unafanya kwa hiyo shamba. Kuna shamba lakini you want to put it into productive use. Hao pia walikuwa wameemploy watu, wakufukuza watu wanakuwa jobless. Hawana income. Not a well thought out idea. It's not a well thought out idea. So we are on the effect of what? I hope we've got up. Okay. We are on the effect of inflation. Effect of inflation. Now, when you talk about effect of inflation, you just have to look at the demand and the demand pull and the cost push inflation. And these effects are not necessarily bad effects. They may be good or they may be bad. You have to look at it. So you look at the effect of inflation, effects of inflation. You know, if it's demand pull, the demand for goods are too high and the prices are going up. We had talked about price mechanism sometime back, and we said the price mechanism is what dictates how resources are allocated in the economy. So when the prices are increasing, it's a signal to the producers to shift their resources to producing that goods whose prices going up together. That's what we saw. So for one, if we take that direction, demand pull inflation, it then may result in increase in investment together. Investment will increase investment. So when we talk about effects, we have to look at both. These are, of course, I think I will bypass something else. There are other courses we shall discuss. There are other courses that I want to discuss here. So let's first discuss the effect there. We come to those other courses now. Other than the demand, there is the cost push. There is also other courses. We shall come to that later. Now, we talk about increase in investment. How far we explain this clearly? So, I'll say when the demand is high, demand pull inflation, prices are increasing. It is an incentive for the investors to increase investment together. And as they are increasing investment, employment also increase. Employment, increase in employment or decrease in unemployment. So increase in employment. This is the same thing. This is also the same thing as decrease. Decrease in unemployment. And we have seen that. Then, so we have said investment will increase. Then, other than that, there are also other people who will actually be able to lose. There are people who are going to lose here in this situation. Those who are going to lose, for example, are lenders. Lenders are going to lose. Creators are losing. Why? They are lending money. When the value is high, they are receiving the same when the value is down. Because we have said the value of money is the amount of goods that can be bought by a given amount of money. So when the money was being given out, the money was able to buy more goods. When it's now being returned back, the prices of goods have gone up and said less goods can be bought. So the value of money has gone down. So the creditors or lenders are losing. They lose. Creditors or lenders lose. So they lose because they basically they lend when the value is high, but then whatever they receive back is less. The value is less. Again, we have the borrowers do what? The borrowers or debtors, what do? They get. Borrowers again, they pay less. The value because of the less they gain because they pay back. They pay back less value. They pay back less value. Then we also say some other people also lose fixed salaried people. Fixed salaried people also loses because the prices are increasing and your money is doing the same. So you are losing. So fixed salaried people, so fixed. So we talk about fixed income. Fixed income, workers or labor. Also they lose. Why do they lose again? Even without this, remember you run this 10,000 in mwezi, lakini bei ya vitu inaelekea juu. Bado the 10,000 ulikuwa na earn the last month, ndio utakuwa na earn 10 years to come. By the end of the 10th year, when you are still on the same amount, your life will be pathetic. Compared to how you started. When you started, you thought it was something. This 10,000, this 10,000 shillings you're talking about. If you would be earning it, let's say in 1990s, it would be a lot of money, or early 2000, a lot of money. But now, ukipewa msara ni 10,000, utaenda kwa hiyo pay cash. Hiyo acha. So you become what we call voluntary unemployed. You become what we call voluntary unemployment. You are volunteer to become unemployed because you have just because of the wage rates. So it's not about. So we have fixed income workers, labor, they ask about labor, they lose. Again, there is general decrease in purchasing power. So the purchasing power goes down. Purchasing power goes down. Now, again, other than this, also there's also widening gap. Yes, widening between, or just say the increase. Just say increase in unequal distribution of income. So the gap widens. The gap widens. How are you? How are you? Are you able to concentrate? Yeah? Are you sure you're able to concentrate? Yeah? Save what I watch by that. Just save them. You will watch it later. When you're watching. So you can save them. Yes. So in anything in unequal distribution of income, because we are saying you can even talk about the widening of the gap between the rich and the poor. Can you talk? That's also correct. Together. So the poor, of course, if you talk about investors, they're able to invest, so they exploit the situation. They're able to exploit the situation. We proceed. So basically, the effect of inflation. So these actually, you can actually be able to look at this as the effect of inflation. Now, I'll say that I've forgotten about other causes other than the demand and other than the cost push. We also have other causes like hoarding. Hoarding. You know what hoarding means? Hoarding means what? Hoarding in a machine. Hoarding in a machine. When you are hot. Hoarding in a machine. Okay, suppose today you can have sugar, and you keep for yourself. Then you create a shortage in the market for sugar. What will happen? What will happen? The some price will go up. So in this hoarding, you don't just take about any isolated case. For example, if these big companies which are actually in charge of distributing of petroleum products, they decide to hoard the petroleum product, what will happen? They decide to hoard the petroleum product. They withhold it. They don't release it to the market. What happens? There will be scarcity, and that scarcity will result into the cost of the petroleum going up, and that will have a ripple effect of increasing in the transportation cost and so forth, and the cost of the price of goods will be going up. To talk about hoarding can also be another cause of basically cost of another cost of inflation. Now, I think that we have discussed those. Then control of what? Control of inflation. Control of inflation. I have this. Do I have this or that? Where do I have? This is not control of inflation. So we have ways in which can be able to control inflation. So control inflation, control of inflation. So there are three ways in which inflation may be controlled. There are three ways in which you are able to control inflation. Talk about fiscal policies. Talk about monetary policies. So other ways. Monetary fiscal policies. Monetary policies, other ways. Now, we start with the fiscal. So remind me about the target of the thing. I can speak myself. I can have this one. So let me have this side. So let's look at those ways in which you're able to control inflation. So we talk about the first one, fiscal policies. Whenever you talk about fiscal, it's about taxes. It's about government spending. fiscal policy. So whenever we talk about fiscal, it's about the government taxes and expenditure. So the government will actually devise policies around taxes and expenditure so as to control inflation. So these are this refers to taxation and expenditure. Expenditure policies by the government. A government in controlling inflation. So I say again, whenever in fiscal tax, government spending. So we talk about tax is also revenue. See, government revenue. So tax, because tax is the government revenue. So we talk about tax, that is actually fiscal policy. So in this way, what can the government do to reduce inflation? We have discussed somewhere in the demand pool about increasing government spend together. So the government can then reduce the spending or expenditure, the government reduction in government expenditure. Expenditure or spending, government expenditure or spending. So if we reduce the government expenditure in the economy, obviously that will mean that there will be reduced money, and so basically the government basically it will be checked down. Again, nothing. The government may increase direct taxes, sindio? Kama sasa hivi mnataxiwa kabisa, sindio? Si mnataxiwa kabisa. Kila mtu analia. Kila mfanyikazi analia. Anani analia? Kila mmoja analia. Taxes. So that you are not purchasing power yako imeenda chini. So hakuna prices hawezi enda juu, hakuna mtu wa kubuy, sindio? So prices hawezi enda. So the government can increase direct taxes on income by increasing. Wanachukua pesa kwa. Take money from. So increase in what? In direct income tax. So you increase it. And when you increase the taxes, you have nothing to spend. So the demand will not be affected. You have nothing to spend. So ukishalipa nyumba na ubakishe kidogo ya kukula kwa batibati, si ndio? All of that month is gone. Again, we are talking about the cost push. And the cost push, we talk about the increase in the direct taxes like VAT. You can reduce it. When you reduce it, that VAT, for example, 60% will not be there. The price will be down. So reduction in indirect taxes. Another thing, what the government can do, the government can also borrow from the people. They can also borrow from the people. So if they borrow from the people, of course, the government can also borrow. So government borrowing. So government borrowing can also do the trick. Borrowing. Government borrowing internally. So we have external borrowing. External borrowing is when we are borrowing from producer, IMF, World Bank, and so forth. So we can also do that. You can also do the trick. Now that's fiscal policy. Now we go to what we call monetary policy. What?
So I don't know about the government can also issue the treasury bills.
Oh, so that one I want to specifically be under central bank. Yeah, so this we talk about monetary. So when we talk about monetary, it's about central bank now. When the monetary policies, it's about central bank. And central bank is also government, isn't it? But you see through that. So it's an agency of the government which is also assisting government to achieve some of its macroeconomic aims. So other than the government doing this directly, the central bank is also there to assist. Like an agent of the government to assist in doing that. So we are saying this refers to calculation of policy by the government controlling inflation. So you go to what we call monetary policies. Monetary policies. And we talk about money. Money comes from where? Money inatoka wapi? Central bank. Si money inatoka kwa central bank. So monetary policies by the central bank. So we talk about these are policies by the central bank to control inflation. So basically, what are these policies now? What are they? So we have one. We also talk about raising the bank rates. The bank rate refers to the interest rate. That's our interest rate. So when you increase the interest rate, people will not borrow. For example, you increase the interest rate becomes 50%. Ukichukua 100,000 warudisha na 50,000, utaboro kwe. So 50,000, then you borrow 150%. Unarudisha na 150,000. No, you just keep off. When you keep off, it means the demand is checked down. So remember, we said one of the reasons why the demand actually increased is because of the reduction or decrease the interest rate. But where that is increased, obviously, it's by the central bank, the demand will be people will not demand, will not borrow, and so the demand will be checked down, and therefore the inflation will also be checked down. Also, we talk about reserve increasing the reserve requirements. Reserve requirements. Reserve requirement. What is this reserve requirement? Now, basically, reserve requirement is the amount which is available for lending. So normally, the central bank will direct, will give a rate, will give an amount to the commercial bank to keep, so that it's not available for lending. So you cannot lend everything. You cannot lend everything as a bank. So there's what is reserve. That one you cannot touch. So when during inflation, it's increased. And so when it is increased, it means that less is available for lending together. And so when it's less available for lending, it basically means inflation is checked. So increasing the reserve requirement basically reduces the amount of money, available for lending. Hence reduces inflation. Increasing the reserve, the margin requirement, the margin what? Margin requirements is the difference between the loan that you are borrowing and the value of the security that you are giving for the loan. I hope you are communicating. Now, if you are borrowing 20,000 shillings from the bank, the bank they require that you bring a logbook ya gari yako. So you can see logbook ni pesa ngapi, gari ni pesa ngapi. What 1 million? So the security is 1 million, and you are just borrowing. You say, yeah, let's just keep it. Keep your money. Keep your money. So the margin requirement is actually widened, increasing. So the difference between this and 1 million is so much. So it will discourage you from more. Increasing the margin requirement. So it discourages people from borrowing. So when we are there, because not all people may have the cash. So not all people are there. So you can see then you may not have that. Or you are told to bring the title deed. And piece of land costs several million. So you just keep off. So this is margin requirement. Is actually the difference between the money that you want to borrow and the value of the security that you want to offer as collateral for that loan. So If it's increased, the borrowing basically be able to discourage. So increase the margin of requirement, increase the margin requirement. Say this discourages borrowing and control inflation. Remember, you have to see how it's controlling inflation because the demand is low. The demand, people are not able to borrow. They don't have the money. The demand goes down. So the borrowing basically the inflation control. So we also talked about open markets, open market operation. So this is what we are talking about. Together, selling and buying of government securities. Of course, the central bank can do that. So during inflation, we sell. When we sell, we are getting money back from the economy. During deflation, we buy together. So by buying and selling of the during inflation, the securities are actually sold out, and during inflation, during deflation, the opposite happens. So these are ways in which the central bank may be able to, through monetary policies, they are able to control inflation. So if you are to discuss the ways of controlling inflation, talk about fiscal, monetary, and others. But if the question is specific, when the question is specific on monetary, you have to focus on this. Together. When the question is specific on fiscal, you have to focus on this. So it depends. But if the question is general, then killer activity becomes a point.
Evaluation policy.
How is it causing that? How is it causing inflation? Because remember devaluation, when we are devaluing, we are increasing exports externally. Remember externally. So we are not affecting anything internally. Inflation is about internal. Together, internal. Now that you also have reminded me, another cause of inflation is what we call borrowed inflation. Borrowed inflation. Together, other than the hoarding, there's also what called not borrowed. You call it imported inflation. Imported inflation is whereby if there's inflation is being experienced in Uganda and you are buying goods from Uganda. So by importing goods from Uganda where there is inflation, it's like we're also importing inflation. So we call it imported inflation. Are you communicating? So I could be. That's why it is inflation. Which means because we are buying from a country which is experiencing inflation, we are also going to start experiencing inflation. And that's why I say imported. We have imported it. Like we are imported Corona. We import from other countries. We also started explaining Corona because people came from those other countries with Corona. And so they have to explain Corona. The same way, when you buy goods from those countries which are experiencing inflation, we also start experiencing inflation. We call it imported inflation. So another reason is imported inflation. Another reason, of course, the cause of inflation is imported inflation. So we have hoarding. Now, you are talking about, what was your point? Devaluation. Remember I said devaluation, what would you say? A delivery attempt by the government to lower the value of its external outside the country. Outside the not internal. It's not internal. That's why it cannot cause the inflation. External, not internal. Inflation is within the boundaries. We're discussing within the boundaries. So those are that. So other measures. We can control population. Together, when we control population, we talk about somewhere there. One cause of those demand pool was increase in population. So we can put in place population control like family planning measures, population control measures. Increase in production. When we remember we say demand, there's an increase in demand compared to supply. There's a shortage of supply. So what we do when we can decide to increase production, this means the demand is going to be checked upward together. So which means the demand is able to match the supply, and therefore there is no increase in prices. So we can also can basically talk about all those measures. So yeah, you are told to actually discuss the cause of inflation. You're able to do that. Type of inflation, you're able to do that. If type of inflation, you're able to do that. And how we are able to basically control inflation, we are able to do that as well at this point in time. Now we have That's that. We have target inflation. Target inflation. We have said that when we have a zero, if you have a zero inflation, let's not go to the country because it does not estimate investment. You should actually be targeting around 2% inflation total back. So target inflation, then you can find a particular equation 2 marks and explain what is meant by target inflation. Target inflation. And so what is this? It is a deliberate attempts by the government to achieve a given rate of inflation so as to stimulate economic activities. That one, target. Invest the 2 marks. Explain what's meant by target inflation. Target. So because 0% inflation is not to go right. So at least we should have some level of but not run away. Not run away, not galloping. So that's then we have lastly what we have on Philip curve. Philip curve. We have lastly Philip curve. We have lastly we have what we call Philip curve. Philip curve. Now hope we are now that curve was given the name of the person who devised it. So it was actually by Philip was a professor of economics, was trying to explain the link between inflation and unemployment. And interestingly, he came up with a conclusion that there will be a low unemployment at a high inflation rates. And so he talked about that curve. So Philip curve. So Philip curve. So this curve explains the relationship between inflation and savings. The curve demonstrates that there is a high level of unemployment at high inflation rates and vice versa. So this curve, it's actually the basis of trying to look at target inflation. So it can be demonstrated and demonstrated. So this is how it looks like. So we have inflation rates, we have unemployment. Remember, when there's a high unemployment, level of unemployment, it means people are going to have jobs. The high level of unemployment, majority of people have jobs. Yeah, somebody. Hello. Yes, hello. Okay. So how we are to get up to that point. So we are talking about we are saying this curve explains the relationship between inflation and unemployment. So we say the curve demonstrates that there is a high level of employment and a high inflation rate and what's up. So as I'm saying, because was basically explained for the first time by Professor Wu. By who? Billy. So this is what we have. We have saying so this is so you can see what is happening there. So if we have any point up, so this is you can see any point there. So just look at what we are seeing. So if you are here, if you look at this particular point, inflation is high still. And what is this? Unemployment. Unemployment is low. Good. Unemployment, where are we? The curve is that there is a high level of unemployment. High level of unemployment, the unemployment is high. What happens? When unemployment, when we have more jobs, when the unemployment is low, it means more people have more income. So it should be the other way around. The curve is that there is a high level, should be low level unemployment. So when low level unemployment, if you see low, few people are looking for the yeah, so it should be the other way. The curve is that there is a low, low level. So low level of unemployment is high level with low. Isn't it? So if the curve will say that there is a low level of employment and a high inflation rate. You can see if we have that rate inflation, the employment will be low. Alright, now look, and if the inflation will go down here, the unemployment will increase. So it means majority of people will be without jobs. Unemployment increase. Are you communicating here? Unemployment is when people don't have jobs. Are you communicating? When people don't have jobs, talk about unemployment. So when say it is low, it means majority of people have jobs. When unemployment is low, inamaanisha watu wengi wakuna kazi. Is the so when the unemployment is low, it means employment itself is high. Like together. When unemployment is high, it means employment is low. Like together. So this is what is being explained by this curve. Well, at high inflation, there's low unemployment. Low unemployment means majority of people have jobs. How we are looking?
Yeah.
Unemployment and inflation.
So if inflation goes with the
when inflation is high, what happens? Unemployment means what? When unemployment is low, what does that mean in terms of employment? More people have jobs? Exactly, that's what's being explained here.
On that.
Look here, we had said that when the prices are going due to demand, for example, prices are going up, investors are actually have the incentive to invest because there's high prices will motivate them. Did you say somewhere there? So this guy is studied the relation between inflation and employment. So when the prices are going up, investors will invest. And when they invest, they employ people. Yes, but then I come to you.
That's not.
Yes.
Inflation.
Yes.
I think inflation is when the economy is not very good.
Yes.
When the economy is not very good, I think there's a
disequilibrium.
there's a disagreement.
Yes.
So I'm still finding it hard to understand this.
You know, I said when you are talking about this thing, you have to understand the causes. We have the cost push and the demand pull. When you talk about demand, there is increase in demand but less supply. So the demand is the very price of price to go up. When the price are going up, as a result of that demand, what is the signal to the investors? What is it? To invest. To invest. So you come to understand from that concept. Because when I say this is a question, look, you check on the point both from the demand and the cost. So from this, if it's about unemployment, it means people are investing. So unemployment is low. The investors are investing, and they are investing when there's demand for their goods. They only invest when there's demand for their goods. And the prices are rising. That's when they invest. And when they invest, they will create jobs for people.
When there is no money in the market. Now I get it.
You get it now?
Yeah.
Okay, thank you. Yeah, what is your concern?
When you are asked the relationship between the inflation and
So I think I will say explain somewhere there. The curve demonstrates that there is a low level of employment at a high inflation rate and vice versa. It's already explained there. So you can see here high inflation, low unemployment. Low inflation, high unemployment. So able to explain that. You can see. So high inflation, unemployment is cheap. So what more people have job. But when it goes down, you can see now more people, unemployment also increases. Unemployment also. Unemployment. Please. Remember again, we say it depends on the inflation. So, and remember, you also talk about targets. You can see this one. Target inflation. You can see. So, it depends on the inflation that's happening in the economy. We have inflation, yeah, but like run away. You cannot say you want to have a runaway. That one cannot be better. So, it depends on which inflation you're talking about. Which inflation. Together. Not all inflation are bad. When it is low, like this one, like 3%, it's not right, it's not bad. But you can see if it's now above 6%, that's when we start getting concerned. But when it's 5 to 4, 3, it's not bad for the economy. So in this case, we may be talking about, we have to be talking about runaway inflation here. Because now runaway become counterproductive. Runaway economy become counterproductive. Because even investors, when there's a runaway inflation, it's also what we call capital flight. Investors are also running away from the economy. Investors. So now when we talk about this in terms of this explanation, we don't say, so this inflation is good. No. We are talking about the type of inflation. So not all inflation are bad, not all inflation are good. Yeah. So I hope we are together there. Any other question? Areas of we still getting confused. So if you are told to explain the flip curve, I hope you are able to explain it. I hope you are able to explain it. So this is what we call inflation. Higher. So that's the end of this topic. Employment, and so I think I can take some 10 minutes to discuss the new topic. Then we pick from there on Saturday. Now the new topic, I think I already posted there. Money and what? Money and banking. Where up? Higher. Now at this juncture, any question on employment, any question on unemployment, any question on inflation, should tackle it head on. How many minutes? Head on? Head on means so head on means you don't spare it. All the marks you're supposed to get there, all the marks. So all the marks of inflation, you're not supposed to spare it. Any question of those. Remember, as I've said, there are 7 questions. You only need 5, and over those 5, suppose 4, you must get 4 good ones. Or if you can even decide you will pick on 5, so you average 14. 14 times 5, 14 times 5, so already you are at 7. So 14 marks for each question, 5 questions. You 7 questions, you only pick the 5. Then 5, you target around 14 marks each. Then you are a tick, but don't target 50, because if you target 50, you get it. So you fall at 4. Don't target 50, target 70. So that will target 80, 70. Can actually be able to fall at 5 or 6. But if you so there we are. So where are we are? Money and banking. Money and banking. Money. Money. Yes. So you can see we know that. So money. So on this topic, we must understand again what is money. We must understand the concepts. So we have concept there, concept of money. We must understand characteristics. Characteristic of money. Must understand the functions of money. We must also understand demand and supply for money. Those are what you want to understand here. Definition of money, concept of money, characteristics of money, function for money, demand and supply for money. And the money, now that's we know what money, we are saying anything that is legally accepted as a medium of exchange and as a measure of what? Value. So definition. Money, anything legally accepted as a medium of exchange and a measure of value. That is what we call money. Anything that is legally accepted as a medium of exchange and a measure of value. So remember, in the early days, we talk about barter trade. So money came around and actually solved the problem of barter trade. So we have to say anything legally accepted as a medium of exchange and as a measure of value. So we want to look at some, before we go to the concepts. Concept of money. So we have so many concepts of money. We have so many concepts of money. We have so many concepts of money. So we shall be able to look at each of those concepts. We can talk about token money. Token. So this that is one side. Quasi money. So you can say about this is also you can talk about near money. Near money. So this is any assets. This is any asset. This is any asset that can readily be converted into money. Any asset that can be converted into money? What is that asset? Is it a piece of land? It's a piece of land. Okay? Is it a piece of land? Is it a building? A chair? What is this asset that can be converted into money? What? These are the bills. So, once I buy on your money, basically, when we talk about this, talk about this like check. Check. Together. But a check itself is not really that money as such because rather to check when I'm more so. Rather than more so. But you can easily convert it to money. You can easily convert it. So we talk about what side money. What side money. Yeah, but okay. Okay, money. Okay, money. So this is money. This is currency. Currency whose face value is different from its intrinsic value. Token money. Face value, these are versions, concept of token money. Last time, now you can have 1,000 shillings. The face value is 1,000, like the one that was rendered useless the other day. Those 1,000. If you are to sell it, would have you 1,000 back. If you are selling for its own sake, will you get that 1,000 back? So the face value is higher than the intrinsic value. The intrinsic value can be understood as the cost involved in this production. Cost yake ya kuitengeneza. Is it the same as what is written on that? No, it's a different. Talk about token what? Token money. It's a currency whose face value is different from its intrinsic value. So say 1,000 notes, the value is higher compared to the actual value of that item on its own. Right? Well, intrinsic token money. You also have what we call but three legal tender. Legal tender. Anything is anything that has to be backed by law. As money. Legal tender. So anything that has been backed by law is money. It's called legal tender. We also have number 4. Commodity. Money. Any assets. Used as money. Past. Any asset use of money in the past. It depends on the cost. So if you read this, so those who read this, sometimes some queries, of course, depending on the queries that you are using skills. Skills are count skill as money. I mean, those were reading this. Different assets were used as money, so called commodity money. Fiduciary what? Currency issue, not backed by gold. Sometimes back basically when you have to issue currency, there must be gold reserve. So basically that was done away with, and therefore the currency can be issued without any equivalent gold basically backed by gold. So any currency issue which is not backed by gold is part of the fiduciary issue. So we have number 6. Yes. Yes, money. Yes, money. Yes. Yes, money. So this is a currency. This is currency. That's without money and it counts money by an act of parliament. We have number 7, nominal. We have nominal money. The value of money not adjusted for we change prices. That is inflation. Are you together? When now nominal, whenever we nominal, that which is what basically adjustment of price changes. Price changes here is inflation. Then we have real income. Real income or real money. Real income, that's real money. So we talk about real income, real income or real money. The value of money. The value of money adjusted for inflation. Are we there? Concept of money? Right. When we come next, we shall speak on the next item, which is the currency of money. So those concepts, so if you're told fiat, token, quasi, legal tender, commodity, nominal, real, fiat, fiduciary, the question is same. Any question? So we shall speak from the next house. This is clear by Saturday. Then we also get into another topic. So far, we have done international, we have done employment, we are there here, we are doing two to go. We are doing what are we doing? National income accounting, and the other one is what? When we go to a level, when we go to a level, it's around one class. We are done with it. Then probably you get a lot of classes or another one class. So can I have a good evening?